Buying commercial property can be a long process, but if you follow these steps closely, you can ensure that you have a very smooth transaction and buy the best property for yourself. The first one is, what do you want to buy? I get people asking me, look, I've got some money to invest. I've got a couple of residential investments. I've got a small commercial investment, and I want to buy another commercial investment. And I go, how much you've got? And they say, I've got, I could probably borrow up to $1 or $2 million or whatever the budget is. And then I look at the person, their income level, their age, their experience with commercial property or property in general, and whether they're risk takers or they're more conservative. So the answer is, it depends. Do they want a blue chip investment for a supermarket or a national franchise or a service station or a childcare centre? Returning, they might be happy with a 4 or 5% on a 10-year lease. That suits more the older people who've don't want to take any risks, happy to have something to sit there and just get their low interest income every year, year after year, indexed for inflation. You might also be in a situation where you might want to run a business from the property. That doesn't get talked about very much. I had a lot of clients who bought businesses and decided to put them into their own property. It is a larger expense, but how many times you heard the term that I've been here for 20 years and I could have paid this property off twice over. An interesting situation was with a client who had quite a successful business and was paying a fairly large rental in a shopping centre. And I said to them, for that sort of money, you can buy something for about $5 million, the same rental. And I had a property for them, which was about $1.8 million, which I purchased, put the business in there, ran it for a couple of years, consequently sold the business. Now I'm sitting on a nice low income. They want to retire, there's still money coming in. They're probably getting about 12-14% return on their initial investment from 4 years ago. Now, in a situation where they're still paying rent, that money was gone. Now they've got retirement income for the rest of their lives if they wanted to. You may have another property which is run down. You may want to redevelop down the track. You may have that experience. It might be in a process of being rezoned. So it really depends. And I'll go through the details of each of these aspects through the video. But the most important one I'll mention at the end of this video because it will make more sense as I go through the first 14 points. The other thing is locate the deal. How do you find this deal? You can go through the websites, commercial websites, and find properties there, or you can go to commercial real estate offices. Look at off-market deals, like you might know the owners, or you might find out who the owners are and start talking to them. Or you may decide to employ someone like a commercial real estate coach or consultant or commercial real estate agent who's experienced in those businesses, knows all the details of what to ask for, what the values are, and what the possible potential benefits would be down the track, and whether they suit your type of investment. To hold your hand through the whole process. Someone has been there, done that, because it can get very tricky at times. It's very important not to miss any of these steps and to make sure you have the right type of people working with you to ensure your most smoothest transaction. Can be long, sometimes complex process. If you've got the experience on your own, then you do it yourself. But if you haven't, think about working with someone who can help you and guide you through the whole process. Analyze the deal and market. This involves meticulously scrutiny of both the property and the surrounding market. Understand the property's potential expenses, potential appreciation, potential depreciation. Look at the income, the cap rate at the moment, the internal rate of return. Research market trends, recent zoning changes, indicators such as demographic changes in the area, and new developments proposed in the area, which will all contribute to forecasting future performance. Are there new roads going through the area? Are there new businesses moving in? Has there been a change of policy? Transport links? All these things should be taken into account for future projections. Maybe the area is declining. Next point I like most is the adaptability of the property. Now, I call them utility properties. There's no sort of technical, not a normal commercial real estate term. It's a term I use to say maybe an insurance property. It may possibly have, if currently it's an office building, I can maybe do something else with it down the track. And I've had situations where, for example, I've had purchased a motel for someone that wasn't doing too well. We changed it into a backpackers. Situation where years ago we had industrial buildings, we changed it into residential commercial mix, simple subdivisions. So how adaptable is a property? Because if it's strictly, especially if it's a part of a whole building, a strata, you may be limited to what you can do down the track. Whereas if it's a whole building, you can change the use, possibly subject to the current zoning, and earn more money down the track, or change with the fashion. Another important one is, what can you afford? Look at your finance options. Speak to your bank or mortgage broker, how much you can borrow. Look at possible partnerships, maybe join up with another investor, several investors to pool your resources. So if you've got $1 million to spend, if you've got 4 other investors, you can buy a lot more for $5 million. And normally you get a high return and spread the risk a bit. And you'll get their input as well, help each other. So there's various ways of raising finance. That could be some of them. Once you've found something, you're in the situation where you can make an offer. So you analyse the property, it aligns with your financial goals and risk tolerance, your age situation, your current financial position. This mainly isn't really about price. It's structuring the deal to suit your situation, related to your due diligence, financing, and specific property improvements. You should also be prepared for counter-offers and maintain flexibility while safeguarding your interests. For example, you might be able to negotiate vendor finance or some vendor finance. There may be certain works to be done on the property. You may negotiate that the current owner does some work before you buy the property, or you make reductions for possible work. You factor that in your negotiations. Or another situation could be, especially if it's a development site, we've done with clients, ask for an option. Usually an option is a situation where you normally pay 1 or 2% of the total purchase price for a certain period of time, usually 1 or 2 years. That 1 or 2% is non-refundable, so the vendor gets it straight away, no matter what. And then you've got 2 years to get your plans together for the conversion of the property to something more lucrative. Obviously, it doesn't work out, you can walk away, you lose your 1 or 2%. Another option is a put and call option, which is more binding, but we'll talk about that in other videos. Then you go to the real detailed due diligence and inspection. You validate the information provided by the seller and assess any potential risks. Again, you should work with people who understand the situation, obviously your attorney. It could also involve speaking to the council about what they are planning in the area and how it would affect that particular property. Sometimes, which I've negotiated for clients, is an exclusive due diligence period where you've got some time, usually a couple of weeks, to do all your homework, maybe spend a bit of money without risking losing the property. Employ an architect or town planner, talk to council. Apart from the physical inspections, delve into the zoning laws, tenant agreements, environmental factors, and potential liabilities. Engage professionals like inspectors, attorneys, accountants to provide expert insights. So go for the details. I would also suggest you employ a specialised commercial property lawyer. It's easy. People have their own lawyers. They may have helped them in a divorce situation or company structure or something else, and they've decided to employ them for commercial property. Now, most lawyers can do that, but there are complex issues involved, and maybe not all lawyers are experienced in that area. The nearest analogy I would think of, do you go to your GP for open heart surgery? Okay, I'm sure that GPs can probably get through the process by looking at videos and reading the texts and perform the heart surgery with a bit of training, but we'd better employ your GP or a specialist heart surgeon in that situation. The same thing with specialists like attorneys and lawyers. Things can go wrong. Lawyers, like other professionals, can make mistakes. You can ask me how I know. Now you've reached decision point. After your due diligence, assess the deal, how it aligns with your investment strategies. What in the first place might change. So consider and reflect on the property's profitability, the risks uncovered during due diligence, and changes to market conditions. These deals could take weeks and months, and in the meantime, there may have been a share market crash, inflation might have gone higher, there may be a development proposed next door or close by which affects your property value. It may work in a positive situation as well as a negative situation. So obviously your positive situation, you've negotiated a price, so maybe worthwhile going on the deal because you have a good deal, or you may find that things are deteriorated and you've got to factor that in because you may lose 5, 10, 20% of your value because that development close by or some changes in the economy that happen from the start of negotiations to this particular time. So you'd have to negotiate terms to suit that situation. Now it's preparing to close. That includes obviously securing your financing, whether you're going to a bank or mortgage broker or finance company or partnership or whatever it is, working out a management structure, whether you're going to hire someone to manage it for you or employ someone, or you're going to use a real estate company, or you do it yourself. So you're developing a comprehensive post-acquisition strategy. Closing the deal. This is the final steps. Involves a legal transfer, property ownership, and ensure all the paperwork is in order, from deeds to finance agreements to partnerships or company structure, depending on the entity you're buying it under. There is always something new that pops up. So remain vigilant for post-closing responsibilities. They don't always run smoothly. There's always something that pops up which can be rectified, but you've got to be diligent in that situation. Post-closing activities and asset management. Managing commercial property post-acquisition is critical for long-term success. Implementing value-added incentives like renovations, tenant retention programs, and efficient property management systems. Regularly monitor performance and metrics and adjust strategies as needed. For example, are your leases all aligned? Are the leases all being executed properly? Are you following up with rent increases? Are there any outstanding outgoings payable? Go through all these activities to make sure everything is all complete and straight up, ready to go, up to date. Then there's accounting and reporting. It's important that you take care of the financial situation of the property at all times to know what's going on. There are special real estate software you can utilize to maintain records. Consider tax strategies with financial experts or accountant to optimize profitability. Maybe look at employing a quantity surveyor to look after the assets. Maybe there's depreciable assets you can write off in taxation. Maybe you can structure the whole deal in a way which gives you some sort of tax benefits or write-offs. You can offset with other properties you may have or your business or how it align. You need a specialist, accountant, financial controller, whatever it may be, someone who knows that situation. The final thing is having an exit plan, an exit strategy. This gets overlooked nearly all the time. And I have a saying which I recommend to my clients is a day you think about selling the property or business or both is a day after you purchase it. What is your exit plan? Ensure that the property is up to scratch all the time. Maximising the revenue all the time. Don't let things deteriorate. I'll do it next year. Okay, obviously funds are very important. You may not have the funds to do it, but rectifying these things as quickly as possible helps in the long run because You never know. A lot of property deals are done when the owner is at a disadvantage. Things happen quickly because partnership disputes, sickness, divorce, etc. We have to sell quickly for whatever reason. Maybe you're just tired, you want to get out. And you can work it out by the attitude of the current vendors, how they're feeling. Buyer's consensus. They're like vultures. If they know that things are going backwards, they'll factor that in negotiations or take advantage of it. So ensure that things are kept up to date. Maintain your leases. Maintain your property to the best possible condition so that it's making the most amount of income you possibly can. If you don't do this and something happens, when you get a situation, you may have to sell. And then, as happens quite often, you don't want to leave any money on the table when negotiating. I'd like to hear comments. Have you got your exit plan for your property? Can you add any further to this? I cover a lot of these cases. I mention this, particular real life situations in my book, Commercial Real Estate Investing for the Residential Investor. I go specific cases where we've got the highest and best use for properties and how it's worked for my clients over the years. This is Con Tastzidis, and please subscribe to this channel.